Hello guys, welcome to my YouTube channel. This is Kelvin Steve, and today I'll be representing Bluecore Investment Group, or BIG rather, and we'll be analyzing ZCCM IH, the famous mining company. So we'll do this by looking at various financial statements starting from 2021, 2022, and 2023. This will be done by considering various ratios, which will include profitability analysis ratios. Will consider the common size income statement as well as the common size balance sheet. Without wasting much of your time, let's dive into the video. But before we go any further, let me make mention that this video is for academic purposes only, nothing more, nothing less. More will be explained on the next slide. So like I said earlier, this is for academic purposes only, and this is a student project by Bluecore Investments, which is my team, and it is being supervised by Dr. Kaur, who is a lecturer at the University of Zambia for financial statement analysis. Without wasting much of the time, let's dive into the video. Yeah, so we'll look at the company overview, which will include key operations as well as ownership and other issues. So let's start by looking at key operations. So the main activities of ZCCM HI is into mining activities. So besides that, ZCCM HI also owns equity stake in other mining companies in some of the mining companies include the Mopani copper mine, then you have Rubambe copper mine, and as well as the Ruwansha copper mine, to mention a few. Now, that being said, I'm sure you are all asking yourself who owns this company. Now, as we can see here, ZCCM is owned by the Zambian government, which has 77% of shares in the business. And this ownership is through the Industrial Development Corporation, or abbreviated as IDC, and it is also listed on the Lusaka Stock Exchange, abbreviated as LUSE. Now, on the market position of ZCCM IH, it is considered to be a strategic national asset of the Republic of Zambia due to its massive influence in the copper sector. ZCCM IH drives over 70% of Zambia's export earnings, and on the Lusaka Securities Exchange, it is one of the largest listed companies by asset base, meaning it has a lot of assets. But its market position is complicated. It offers investors exposure to Zambia's mining sector, but comes with high financial volatility, heavy reliance on subsidiary performance, and close government involvement in decision making. That makes sense because as you've all seen that it is owned by the Zambian government, so it has government involvement in its operations. So now let's look at the key headline numbers in thousands. Yeah, then we have revenue, we have gross profits, we have income before interest and tax, then we have income before interest, tax, depreciation, as well as amortization. Then we have net profit loss. As you can see from there, it has been making losses from 2021 to 2023. Total assets, we have those figures there. We have total liabilities, we have total equity, then you have total cash from operating activities, of which we have a negative figure in 2023. Then we have free cash flow to the firm, also abbreviated as FCFF. So we have negative figures as well. So as you can see, the negative figures kept on increasing over the years. That's from 2021 to 2023. On, we'll look at the profitability analysis from the period 2021 to 2023. So we have the gross profit margin, 2.3% 2021, and we have negative 30% in 2023. So we can see that the gross profit margin kept on reducing over the years. Then we have operating profit margin, we have negative 102.7, we have negative 27.8, then we have negative 17.9, meaning the operating profit margin kept on increasing from 2021 to 2023. Then we have the net profit margin. As you can see from the figures there, the net profit margin kept on increasing since it had negative figures from 2021 to 2023. Then we have return on equity. We have negative 98.2, negative 47.9, then we have 71.6% in 2023. That's a positive figure. It had negative figures over the past 2 years, that's 2021 to 2022. Then we have return on assets. Return on assets, we have those figures of which we had an increase on return on assets based on the figures shown below. Then we have return on capital employed, then we have operating cash flow margin, that's 3.2% 2021, then we have 10.5% in 2022, then we have negative 0.7% in 2023, showing different variations over the years. So this a simplified way of showing all those ratios. As you can see, all those ratios in the table given the previous slide are shown here. So it's easy to tell what has been happening to the ratios over the years. Then we have the dew point decomposition analysis. So here we have the net net margin, then we have the asset turnover, then we have the equity multiplier. Then multiplying the three, we get the dew point decomposition. Then we were given net margin profit in 2023 to be that figure divided by the revenue, we get negative 34.7%. Then we have the asset turnover, we have revenue divided by total asset, which was 0.201 in 2023. Then we have the equity multiplier as well, given by total asset divided by total equity, which gave us that, which is 10.27%. Then multiplying the three components of the dew point analysis, we get to have the dew point analysis to be 0.716 plus 71.6% return on equity. Then a simple interpretation is given below that is reported positive return on equity 71.6% is misleading. It is a mathematical artifact caused by negative book equity. A positive return on equity in this context does not mean the group creates shareholder value. Rather, it reflects that losses are measured against a negative equity base. For decision making, ignore headline return on equity, but focus on return on assets employed. Operating margins and cash generation as well. So we'll now look at the liquidity and solvency ratios from 2021 to 2023. So we'll start by looking at the current ratio, which talks about the firm's ability to meet its short-term obligations. Then, as shown in the figures, we had the highest current ratio in 2021, which is 1.25. Then we have quick ratio, which is 0.68 2021, then we have 0.7 in 2022, then we have 0.45 in 2023. Then we also have the cash ratio, which is 0.02 in 2021, 0.03 in 2022, and 0.01 in 2023. Moving on, we have the liquidity ratio shown in a more simplified way as before. Then here we can easily tell what has been happening to the ratios over the past few years. So here we can tell that the current ratio did what? It reduced over time. And here we can tell that the quick ratio maintained its stability, but then it reduced in 2023. Then we also have the cash ratio, which has the same behavior as the quick ratio. Moving on, we will look at the balance sheet highlights of 2023. Then we have the current assets given by that figure. Then we have current liabilities, and we have the current ratio of 0.46. having been given the current assets in the current liabilities. Now the total borrowing reported as zero in the borrowing line for 2023, but liabilities directly associated with assets classified as held for sale were that much. Now let's not take much time into looking at the various parts of the balance sheet and focus on other relevant parts such as the ratios. Let's pay much attention to ratios rather than reading out what's in the financial statement. So here we have activity ratios of that period 2021 to 2022. Then we have the average correction period, the lesser the better. So here you can see that it had the best in 2023, which was 11 compared to these other years. Then we have the average payment period, which 123 days in 2021, and you have 185 in 2022, and we had 7 in 2023. Then you have inventory turnover. So this simply talks about how long it takes for a company to acquire inventory or stock and then sell it out. So here we had 119 in 2021, we had 122 in 2022, and we had 1 in 2023. And here the point is the lesser the better. Then you have inventory turnover ratio. We had 3 in 2021, we had 3 in 2022, and we had 400 in 2023. And then we have interest coverage ratio. We had that having the biggest in 2021. Then you have asset turnover. Given by 0.41 in 2021, then we had 0.25, then we had 0.22 in 2023. We'll simply summarize those ratios into a more simplified ways for easy interpretation, so everyone can understand what has been happening to those ratios in the previous slide. So now let's move on to interpretation or red flags. So inventory days dropped to 1 day and turnover spiked. This is due to near zero inventories in 2023 and can, as usual, distort ratios in the financial statements. Then we have to be cautious on the 2023 inventory ratios because they reflect accounting reclassifications and write-offs more than improved operating efficiency. Then moving on, we have interest cover, which is negative. That is simply because its earnings before interest and taxes were very little than the finance costs, showing the inability of operating profits to cover finance costs. This is a solvency concern that most investors should pay attention to. Then we have asset turnover being low, which is 0.22 in 2023, meaning that the assets base is not generating high revenue relative to its size. So let's look at the common size analysis. So here we'll consider the common size income statement, which is expressed as a percentage of total revenues. So as you can see from the figures below, we have on the total revenue we have 100% to show that total revenue is the basis for the analysis at this point. Then you have gross profit over there, showing that it had the highest gross profit in 2021. Then all these other years had negative figures. Then we have earnings before interest and tax, which is there, of which it had the highest in 2023, showing some growth. Then we had net profit having negative figures as well, of which we have some slight changes, though there's no consistency, so we can't tell what the net profit of 2024 can be. Then you have operating cash flow, which is 3.18% 2021. Then we have 10.54% in 2022. Then we have the lowest of 0.71% in 2023. Now let's look at the common size balance sheet. which is expressed as a percentage of total assets. So here we have total non-current assets, that figure which is 50% of total assets. Then we have the total current assets, we have the cash and cash equivalents, we have total equity, total liabilities, and current liabilities shown over there. Now the percentages are shown there, so I won't say much about that. Then let's go to the interpretation. So here we can see that a large proportion of assets are now held for sale, and they are considered to be what, current assets, and cash is a tiny proportion of asset base. The negative equity percentage is a stark way to convey solvency risk. That's self-explanatory. Okay, now let's look at the cash flow analysis. Here we'll look at the cash flow statement, which shows the inflow and outflow of cash. So here we have the key components, which is the net cash from operating activities. We have net investing cost cash flows. We have net cash used in financing activities. We have net increase or decrease in cash. Then we also have cash and cash equivalent at closing balances. So we won't pay particular attention to the given figures, but let's look at the key observations that were made. So operating cash flow turned negative in 2023, which was negative 83.7 million, despite the positive earnings before interest, tax, depreciation, and amortization. This indicates working capital movements. One of cash cost of financing water are significant. So investing cash flows are volatile in 2023. That's the third observation made. So as you can see, 2023 shows a positive net investing cash flows. So some inflows were one-off financing or investing restructurings rather than recurring operating inflows. So the simple interpretation here is that weak cash generation from operations undermines earnings quality and dividend reliability. So earnings quality and red flags. So one of the top red flags identified in the accounts were negative shareholders' equity, which was in 2023. So ZCCM IH suffered structural solvency risk, which makes return on equity unstable for conventional interpretation. So the second red flag noted was there were large one-offs and fair value volatility. So fair value volatility affects adjustments to financial assets. For example, we have 1,767.1 million in 2023 against negative 205.6 million in 2022, and large impairment write-offs distort recurring performance. Now, the third red flag noted was Mopani exposure and guarantees. So, historical borrowings and guarantees related to Mopani were material drivers for group distress. So, restructuring is ongoing and created large subsequent event disclosures. Main liabilities were classified as liabilities associated with assets classified as held for sale for that amount given in the brackets, masking underlying leverage if not carefully revised. The fourth red flag was earnings versus cash mismatch. So company level profits sometimes arise from investment income or dividend receipts. So our consolidated operations of ZCCM IH were showing losses and negative operating cash flow in 2023. So the fifth one is inventory and receivable swings. So inventory was written down drastically in 2023, which was at 38,499, and this figure caused inflated turnover ratios during the year. So the sixth and last red flag noted was interest coverage being negative. So operating profits cannot cover finance costs as seen in the table. Now, investor consequence, the earnings reported are of low quality for predicting future cash available to shareholders. The investor should prioritize cash flows, contingent liabilities, and the outcome of company restructuring over headline profit figures. IFRS versus US GAAP considerations. So, ZCCM IH considered the following IFRS in its accounting for the period that we are looking at, which is 2021 and 2022 and 2023. So, it considered IFRS number 5, which talks about held for sale. They also considered IFRS number 13, which talks about fair value measurement. So other IFRS considered was IFRS 13, which talks about fair value for measurement. Then moving on due to time, it also looked at IAS number 36, which deals with impairment. Then we have royalty or revenue accounting, which is under IFRS 15, and related interpretations are determined by recognition of royalty income after the concession conversion. Now, what does this mean to an investor? So, IFRS disclosures make many of the one-offs visible, which is helpful, but the heavy influence of accounting judgment means investors must focus on actual cash flows and contracts rather than the headline accounting profit swings. So differences between IFRS and US GAAP would mostly affect timing and presentation, not the underlying economic risks. So after looking at various analyses, including ratios, we've come to our conclusion, which allows that the investor should avoid investing ZCCM IH due to various reasons. For example, we can look at the failure of ZCCM IH to prioritize capital preservation. Now, if you've noticed clearly in the tables, ZCCM IH fails to maintain its equity ratios. So we saw negative equity ratios. We saw net losses. Weak current ratio and negative free cash flow indicate an elevated bankruptcy or default or forced restructure risk. So the second reason is earnings are volatile and low quality. So fair value swings, impairments, and non-recurring investments income drive reported profits in some periods. So consolidated operating performance is loss-making, as we saw from the earnings before interest and tax, operating profits, and other key line items. So the third one is liquidity and solvency risk. So current liabilities far exceed current assets, and a large chunk of liabilities are effectively contingent on previous guaranteed borrowings. That was on Mopani, now reclassified, a complicated and risky structure. Dividends and reliability. The company level dividend may be declared, but the consolidated cash flows do not support reliable dividends for shareholders currently. And this is not suitable for a retiree who needs a stable income on a monthly basis. Now, having concluded that our investor should invest in ZCCM, what are some of the current activities that can make us reconsider our decision? Now, to start with, we have the Mopani transaction legally and financially closed, with independent confirmation of cash injection onto the consolidated balance sheet and removal of contingent guarantees. The second point is post-transaction consolidated balance sheet that shows that the current ratio was greater or equal to 1.0 times. Positive FCFF were observed and sustained positive operating cash flows for at least 2 sequential quarters or a full year. And also there was a removal of a negative equity position, which can also be classified to be a credible recovery plan. So the third point is there is a clear recurring dividend coverage shown by operating cash flows. Now, if our client still wants exposure, he or she should limit allocation to a small percentage of the portfolio with strict stop stop loss and re-evaluation triggers tied to the above outcomes. So we've come to the end of the video. Thank you guys for following. If there are any suggestions with regards to which company we should analyze next, kindly leave them in the comment section, and don't forget to hit the follow and like button. Peace.